Welcome to the Harwood Report for August 20th, 2017. The Harwood Report, as always, is presented by Trade Academy. I am Keith Harwood. I am your host and the founder of Trade Academy. The all-important disclosures, as always, all services and content are provided for educational and informational purposes only and are not intended as legal or financial advice. Read through this whole slide. It's important. Trade Academy is not an investment advisor, is not registered with the SEC or FINRA. Employees, agents, owners, representatives of Trade Academy are not acting as investment advisors. At the end of the day, I talk through some trade setups that I think are intriguing, but you need to do your own due diligence before you put on any trade, and you should talk to your financial advisor. Options do have risk and often are can be riskier than an outright equity position if entered in incorrectly. So think through everything before you put on a trade. This week's highlights, I'm going to go through the normal equity indices, S&Ps, NASDAQ, Russell 2000, Dow Jones. Then we're going to get into the normal rates, Forex and commodities, because they're still kind of giving interesting setups. Dollar, yen in particular, gold. Really like the look of the way that we could potentially play some of that stuff with the miners and junior miners, which I think are interesting and a new thing I want to look at this week. TLT, we'll want to look back at that again as a bond play. And then we'll go into the sectors, Brazil and financials. Last week we talked about South Korea. That seems to be in the back burner now, so we're going to switch over to Brazil, which is actually not something that people have been talking as much about on your normal business TV shows, but I think that there's an interesting potential setup there. So we'll get into that near the end. To start, I want to focus on, first off, pointing out fear and greed here. We're at an extreme fear indication from CNN's Fear and Greed Index. I think it's an interesting note. Partially because we can look at where it's been historically. We were in a very greedy state just a couple weeks ago. Now we're at as sort of a fearful of a state as you've seen. This is measured off of a lot of indicators within the market, not the least of which is that implied volatility increase that we've seen in the VIX. The last time fear and greed was this low was right before the election. Obviously, we rallied out of that very well. But for this kind of an extreme move from fear and greed, in the 80 range down sub 20 is pretty impressive, especially considering the move we've had in the markets. We'll close that up. S&Ps. Oops, we're looking at the gold miners here. Let me go over to S&Ps. In that time span, we've dropped from about 248 to 243, $5, 2%. Last time to have that kind of reading, we were dropping from a range of about 219 down towards 209, so we had close to a 5% pullback. It's a pretty small move to justify that kind of increase in fear in the marketplace, but I think that kind of tells you just how much people have been scrambling a little bit for the VIX, which we really saw more last week with the North Korea situation escalating. That died down. VIX didn't come down quite as much, and then we had these issues this week with Charlottesville, Virginia, and the way that the government has kind of been handling their response. Obviously, people have been very negative about Donald Trump's response to that, President Trump's response. I'm not going to get into my political views on this. All I want to know is how's the market responding to it, and right now it's responding negatively. We also had those terrorist attacks claimed by ISIS in Spain. That obviously put some negative tone into the market. So there's a little bit of justification for some of this fear, the way that these tensions have arisen between the generally far right and far left factions in the United States, and everybody obviously is escalating tension there. The fear about potential for terrorist attacks in Europe. These are causes of that fear. Let's look at the actual charts here, though. The move from North Korea was bought because North Korea basically said they were going to back off and think about it a little bit before they attack Guam. So that didn't matter anymore as of Monday morning. So we rallied. Similar to last week, or the previous week, Thursday we had our big sell-off. Friday we had a fairly stable day. This time a little weaker than last time. Last time was an inside day at least, which was nice. But this time we had a little bit of a break and closed very close to Thursday's low, which was also Thursday's settle. Generally right now it seems to me that the most likely better R&R trade is going to be a little bit from the long side here. And the reason I say that is that we tend to struggle with breaking through big key moving averages. So We've got some good support here at the 100-day moving average, which we haven't been below since the election. Obviously, if that doesn't hold, then we're looking at like the 200-day moving average, which is much further down. But on a bounce, you're looking at a very reasonable potential to get back into this 245, 246 range. So you've got maybe $3 of upside, and you can set a stop below here, down a buck and a half below where we're trading right now. So you've got a decent R&R to the upside. If tensions don't escalate anywhere, you probably get a little bit of that dead cat bounce, little relief rally, as it were. I don't know that I would want to be long the market here, but down here you could play for that dead cat bounce, and I think that's potentially an interesting play. Obviously, a break below the 50-day moving average, and we've got some definite fear to play out in the market. And if we start getting below Friday's lows, I think that you got to be very on your toes at that point. Let's go from SPY to the NASDAQ. Higher moving average, basically, but same kind of idea. It stopped at the 50-day moving average instead of the 100-day moving average. It's a little easier to me to be along the S&P than NASDAQ based upon the stop, because it closed just below the 50-day moving average, and you'll note here that the 50-day moving average is starting to change shape a little bit. Instead of having an upward slope to it, it has a slightly negative slope. 50-day moving average on Thursday, wow, there it is, was 140, 145, and now it's 140, 140. So the slope of the 50-day moving average turning negative tells you a little bit about the quality of that support, I guess. It doesn't have an upward trend from the 50-day moving average. It has an upward trend for the longer terms, but the shorter term is flat. It is slightly negative. Excuse me. IWM, of course, is the weakest of the major indices here, below the 200-day moving average. I don't see a way you can go long this either, just given how low we are. You could use the March low as a stop if you wanted to try to enter along here. This does have the greatest potential upside, more than likely, but it also has the least clear support for me. So here I'm thinking that, given my view that the S&P probably is going to bounce, this will probably bounce, but I'm not necessarily going to look to put it on a trade here unless I do it with defined risk. Maybe you could buy some call spreads, looking at buying the 135, 138, or 136, 138 call spread for the next week or two. But you're not looking at I don't think you're looking for a move back into the 140s without a little bit more clarity over the next week or two. You need a little bit more time to pass to see how the market is going to respond to what's been going on over the last 2 weeks between, like I mentioned before, North Korea and now what's going on in Charlottesville, and who knows what the next macroeconomic event's going to be. But you do have non-farm payrolls in 2 weeks. You do have a bunch of central bank meetings coming up. You do have Jackson Hole. So we've got some stuff coming up that could have a real impact on the market. I guess actually Jackson Hole is this week. Non-farm payrolls next week, and then you've got a lot of central bank decisions to be made in September. After that, we've got the strongest of the major indices, and that's the Dow Jones Industrial Average. And you see that was the weakest really on Friday, while the other major indices tended to be close to unchanged. The Dow Jones had a follow-through, selling off a little bit more. We talked about that the last couple of weeks, where Dow Jones has been the greatest performer. So if risk-off happens, this probably still pulls down to the 50-day moving average, which is what basically the NASDAQ is at. But the NASDAQ was starting from a little bit lower point relative to the other moving averages. Risk-off would continue to be weak for the Dow Jones. But right now, I don't see a need to put on a big trade in that sector either. One other note back on the small caps. A lot of people talk about small caps being a signal, a sort of a leading indicator for the rest of the market. If small caps are weak, that's supposed to be negative, and the rest of the sectors are supposed to get dragged down along with it. Let's watch that and see how it plays out. If small caps bounce back, relatively speaking, get back above the 200-day moving average, then maybe that's not that big of a problem. But if this continues to be weak, it's going to be hard to justify being long the S&Ps if IWM, if the Russell continues weak and goes below the March lows and starts looking to retest this year, which is this year's low, and starts looking at maybe the December lows, and then you're looking back at the levels from before the election as the major support levels. So let's look at, after that's all set here, let's go over to the actual stuff that I think can lead to a more interesting trade. First up, dollar yen. I've been using the 10-day moving average as my key indicator here. Settles below the 10-day moving average, and you're continuing the trend. Settles above, and you've got a potential flip of the trend. It looked like we were going to flip the trend last week. Of course, that was before everything happened with the U.S. government's sort of confidence shift, the general confidence shift in the government, and all of the dismantling of Trump's strategic advisory committees with all these CEOs. Now, the way I'm looking at playing this is that as long as the dollar yen is weak, I expect to see general firmness in precious metals, miners, and bonds. If the dollar yen closes above the 10-day moving average, I'm going to play that as the neutral zone. If the dollar yen closes above the 20-day moving average, that's going to be a little bit more confirmatory to me that we are in a trend flip, and then you're looking at using dips back to the 10-day moving average as a buying area in dollar yen, or in other words, those dips would be where you'd potentially be looking to increase shorts in precious metals and shorts in bonds. Right now, I'm looking at using dips in metals and bonds as buying opportunities, particularly now that we've got a little bit of space between us and the 10-day moving average. So let's go to the first one, GLD. GLD had a very nice week given the start on Monday, Tuesday, and then we started to rally back. Friday was a bit disappointing in gold. Had a really strong open and it faded. We're still looking to break out above these key levels from April and June. The better leverage has been in the miners, and it's still the case. The miners, we can see that when gold was at its highs in April, we're trading closer to 24.5, currently trading just below 23. It had a really nice bid in the morning in the miners and had a really terrible close to the day. The candle looks bad. The Thursday range was 22.95 up to 23.26. Friday's close was just below Thursday's range after starting off above. That bearish engulfing candle is a bad sign. But as long as the dollar yen is weak, I think that there's still some good potential R&R here. This may have had a little bit of its activity due to the option structure. I can show you what I mean by that. If we go over here to GDX, there was a very significant open interest in the August 23 calls. Paper was short these and short the straddle, and I think generally there was a desire for the market to close below 23 from that sense, just off of the option market composition. It's still negative because people that those that aren't even looking at options market understand the way that candle was just very bearish. That said, you've still got this great R&R potential because of Jackson Hole, non-farm payrolls, August 25th and September 1st. September 8th has an interesting setup as a result of that. The options here, you can see the September 24 calls in the 15-cent range. Give you a pretty good R&R. Historical volatility has been right around 21%, so still a little bit below implied vol. But if we look at that chart on the volatility, this is about as low as implied vol gets, and realized vol does tend to pick up here, closer to the 26% range. And now that the big option short in August has gone away, there's a little bit less gamma hedging on the upside. You can see that the open interest on the upside here in the next week's weeklies and the following weeklies is very small. We do have a decent amount of open interest here in September on the 24 strike, but that's $1 away. So I like the looks of potentially going for the September 8th 24 calls. Alternatively, let's look back at our charts here and go to GDXJ, the junior miners. So those are generally going to be even more leveraged than the normal miners. We've seen prices in the 40s this year. The April highs in gold put these in the $37.50, $38 range. So that's a decent amount of upside here, especially given the implied volatility again. This is as low as the implied volatility gets in the junior miners. Again, Realized volatility has been a bit lower here, around 26% versus we said 21% in the gold miners. So it's trading at about a 4 to 5% realized volatility premium to GDX and a 4 to 5% implied volatility premium. But when this starts going, volatility gets to about 33%, so 6 or 7% higher than GDX. Given that and the similar options market structure, you look at September 8th, 35 calls around 33 cents. Potentially attractive. You can go a little further back because there's less vol premium into the September monthly options there. You look at the 36s there for 24 cents potentially. Again, we're looking at a potential move into the 38 range if you get a very big bid. I'm looking for a move probably to 35 or 36 if all goes well, and that's why I'm looking at maybe these 35s or 36s because I think that this would be paired with an increase in implied volatility. Finally, in the rates and Forex world, let's look at TLT. Again, as long as dollar yen is weak, I expect TLT to be firm. This had a much better performance on Friday than in, say, the gold miners. Yes, it did close effectively unchanged. That looks a heck of a lot like the opposite of the S&P chart, where the S&Ps have been weak and then closed effectively unchanged after starting off weak in the morning. If the market is weak and if the dollar yen is weak, then TLT will go higher. If not, then on a pullback towards 125.5, you're looking to buy as long as the dollar yen stays below the 10-day moving average. Again, I think this is sort of the key for me is that as long as the dollar yen remains weak, you can look to buy dips towards some of the 10 or 20-day moving average ranges here. And use that as your opportunity. And if the market gets weak, it's going to be very difficult for us to see justification for raising interest rates. And then that's where you get a little bit more explosive in TLT. And you can see that obviously we've been trading in the 130, back right before the election, we were trading around 130. On the year, really the high is this 128 level, 127.90, I guess. Sorry, there it is, 128.57. But I think you can get that kind of recovery in TLT if macroeconomic problems persist and if the wrong language comes out of Jackson Hole and the wrong numbers come out of the non-farm payrolls on September 1st. It gets you back to looking again. TLT, you can see that there's a vol bid for non-farm payrolls. Looking at September 15th this time, just given that it's lower volatility than the 1st or the 8th and continues to capture non-farm payrolls. I think you'd want to look at these 129s, knowing that that's your breakout. If you want to be long these for 48 cents, you have to understand that you got to get a breakout in TLT for this to play out. But if it does break out, volatility should increase. Again, we're trading relatively low on the implied volatility scale relative to history, given where we are in the other macro products. If we look at SPY, it's trading at more near 6-month highs. Volatility is, that is, near 6-month highs in implied volatility for Russell, near 6-month highs. So all the equity indices were getting near 6-month highs in implied volatility, and yet TLT is near 6-month lows. And as a reminder, what we said with the miners, they're at 6-month lows in both miners and junior gold miners. GLD, on the other hand, was basically in the middle of the range. So I think TLT gives a little bit more interesting setup on the volatility space than gold. And obviously the miners have the most leverage there, but TLT just had a better looking chart overall. So you're a little bit more willing to give up a little bit of that volatility edge just based upon the quality of the chart there. Again, so we're looking at the 129s there for 48 cents. And I would love to buy those a little bit cheaper if we can get a dip back towards the 10 or 20-day moving average in TLT while the dollar yen stays weak. Dollar yen gets too strong, then all this goes to hell, and you have to start thinking about the puts because of the low volatility and starting to think about a move back towards 124 or 123. That gets, potentially decent R&R as well with the SEP 124 puts. This is all going to be very much contingent upon how the market reacts to what's been going on macroeconomically. And then, as I said, the next 2 weeks, Jackson Hole and non-farm payrolls will give you an event that can cause a gap. And so if we're set up right, you can get a lot of leverage to play for that gap. And even if it's a coin flip, if you're getting a coin flip, but you're getting a lot of leverage for if the market comes up heads, where you're getting paid 3x on heads and losing 1x on tails, that's a good setup where you just got a really good R&R and you're willing to take that risk. Let's go over to the two sector trades that I thought were potentially interesting here. Actually, we're going to start with XLF and we'll end with EWZ. So the financials, last week I was talking about them with the concern of potentially closing below the 50-day moving average and being able to play then for a move back down towards the 100-day moving average. Obviously on Monday we gapped up and stayed relatively firm until things changed again on Wednesday, Thursday. Thursday we closed below the 50-day moving average. And Friday we had the exact same reaction as the rest of the market. I wouldn't be surprised to see us retest the 100-day moving average again with the dollar yen strong. Interest rates dropping. As interest rates drop, that tends to be weak for financials. So you want to be looking at this as a potential sell rallies mode, a close above the 50-day moving average, and I get a little bit worried that we're going to go back up here towards back above 25. But obviously that's a pretty tight range. So you close above the 50-day moving average, which is 24.80 roughly. You get about 15 or 20 cents of upside, and then I still think you want to be selling that rally, barring a shift in the overall flow and stocks going back to making new all-time highs and everything else being so happy and joyous again. The problem here, the implied volatility isn't particularly cheap in the financials. Near highs, much more like the equity market than it is like the bond market. The way that I actually am thinking you may want to look to play this is, given the volatility here in the September 8th options, you'd look towards buying 16% vol on September 8th with the 24.5 puts and actually sell this week's 24.5 puts at 16 cents, which is closer to 19%. Ideally, I'd love to see a bounce in the market with the ability to buy implied volatility around 13.5%, but I don't want to see too big of a bounce. So it's a very fine line where you need to bounce 20 cents or less than, just under 20 cents, 15 cents, stay below the 50-day moving average on the close and get a volatility hit. Otherwise, it's going to be tough to make a big trade here. If you're looking to put on that bearish trade, I think you're either looking at a put spread. As I mentioned, put calendar was the first sort of concept. You could look at the September 8th options that you've got non-farm payrolls and sell August 25th. Or you just do a put spread if you want something a little short term, buying, say, these August 25th, 24.5 puts, selling the 24s. You're only paying a dime. That way it reduces the cost a little bit and you're selling a big vol premium there on the 24s. And I do think you're going to have a tough time getting below 24 too quickly, just given the potential support that's going to be sitting around here at the 100-day moving average, and then also just below 24 at the June low of 23.81. Sorry, that's not the June low, the June 23rd low. Apologies, we were a little bit lower at the start of June. So XLF, it's a put spread market, not a outright put. Finally, EWZ. This is kind of interesting to me. So Brazil has been in focus for a lot of corruption problems in their government. You can see that the most recent corruption, well, I just got some airplanes going overhead here, the Blue Angel, I believe, dropped EWZ from 40 down to roughly 33. That was a big break, and we've recovered that entire break. The low of this day was 39.04. And we have completely filled that gap, with Friday's close being 39.03, and obviously we've had a little bit of trade above 39.04. So this gap, we filled this gap, which is something that a lot of people look towards happening when you start getting recoveries. The question is, what's next? If we can have an overall macro economic firm situation, this actually may be where you get your best setup anywhere. And the reason is you're close to the all-time highs. Didn't really have a pullback during the most recent issues. Obviously, the issues of last week were more U.S.-centric than South America-centric. Got a pullback from North Korea because that's more of a global issue. But if there's no global issues, there's no real need to sell Brazilian stocks. So if Brazil firms, and Brazil looks at potentially breaking out above these recent highs, 46 in May and 40.80 in February, you could have a real nice takeoff here. I'm looking first and foremost for a close, sort of above this range here. We had the high here of 39.13, 39.04, and 39.11, I believe, on Friday. So I got to get a little bit of price action above there. But if we can get a close near 39.25 or 39.30 or something that you start getting through those levels and it becomes clear that we're going to close above there, then I want to look over at the calls. And the reason I like the calls here is the implied volatility level. Much like gold, you've got a lot of leverage here. We're trading at 6-month lows in implied volatility. Historical volatility has been a little bit low, 16.5%, 17%. Obviously, that's because we've had a little bit more chop here, but it's sort of sideways chop. Longer term, that you can see the normal volatility is kind of right around the 25, but high 20s, maybe into the low 30s. So this 23% vol is not expensive by any means. And even cheaper, if I look into September 8th, I can get this volatility at around 21%. My breakout was above 40.5, maybe into a move towards 41.30. If I do sort of my normal calculation here, 24 vol is the one standard deviation move with 24 vol was 1.5% per day. Over the course of 3 weeks, that would be roughly 6%. Call it $2.30. That would put you towards 41.30, just above these 41s. 40.5 for 24 cents, 41s for 14. Both look very attractive. I like the 40.5 as just below the major breakout level on the stock. And then if we go towards 41.30, a one standard deviation move, you're going to get paid pretty well. And generally speaking, you'd have to get towards 41.60 for the 41s to be better. 41.60 is still, I'm still comfortable being long the 40.5s for a move to 41.60. If I thought that our big move was towards 42 or higher in the near term, then I'd want to be in the 41s. But I like these 40.5s, 24 cents, very reasonably priced, play really well for a breakout to new highs. And if the market does rally, this is a really nice way for us to play that, I think, with volatility cheap here and no real reason to sell Brazilian stocks, given that we've recovered from the recent political turmoil and have been relatively strong. So just to wrap up here, I would say that the R&R is a little bit to the long side on the equity indices, with S&P probably giving some of the better potential return profiles, just given the risk reward there. NASDAQ and Dow Jones were at the 50-day moving average, S&P at the 100, and Russell 2000 below the 200, so weakest of the group, but just the hardest to define risk there. Rates, forex, commodities, dollar yen continues to be weak, and that helps to create a bid into the precious metals as well as into bonds. We're going to continue to watch the 10 and 20 moving averages there to see how they handle them if the dollar yen starts to bounce. And I think the sector indices give some of the better plays as well. Brazilian stocks, as I mentioned, have that potential for a breakout, especially if the markets on the whole recover from last week's weakness, especially given the relatively cheap implied volatility level there. The call side is very attractive. Financials would be your potentially weakest play, but you're looking at spreads there just given where volatility is currently. If we get a market bounce and financials start to roll over, perhaps the implied volatility can get back to that 13% level. It gets a little more interesting in some September 8th, 24.5 puts, but for now I'm looking put spreads or put calendars there. Contact me. There's the website, tradeacademy.co. Keith at tradeacademy.co. If you have any questions, feel free to email me. That's the best way to get a hold of me. If you want to have a phone call, 312-600-8004. And finally, follow me on Twitter at tradeacademyco. Thanks again for following along, and I'll talk to you next week.